All right. Hello, everyone. Welcome to Tax News Live today, brought to you by the Income Tax School. Thank you all for joining us. I hope you all had a great tax season. My name is Eric Zeberline. I'm a marketing assistant here at the Income Tax School, and I'm with two of our favorite enrolled agents in Central Virginia. We have Ty Gaines and LuSundra Everett. If you have any questions or comments, feel free to message us on Facebook. Let us know if there's any issues with the sound quality or anything. We'll try to get to as many questions as we can. But yeah, let's jump right in, and ladies, take it away.
We made it.
Tax season 2018 Survivors.
Survivors. It's still going. It is still going. Holy cow.
This is going to be, I thought last year was going to be bad, but this is going to be one of those years where people just keep showing up, like, randomly. Like, either letters are going to keep coming from the IRS or the state, or people are just going to come and say, hey, I didn't file yet, or here's that one last document. I just feel like this season, although it's over, it's not over.
No, it is completely not over. Because I read briefly, I caught a headline where the IRS was saying that there were like a record number of small business owners who were filing extensions, and mainly it was because of all the horror stories. So like this is the season of what happened. Yeah. That is what this is the season, because
people are scared. They heard a lot of stories. You can't believe everything you hear.
Right.
But some of it was true.
Right. And so, so really I think today we're just going to go through kind of the what happened, because people, I know there are people that were my clients or just clients nationwide who were basically walking away from their tax professionals and, going, what happened here? Right. And so, one of the things we heard about was, oh my gosh, my refund is gone. Or, people that ordinarily did not have a tax liability suddenly had a tax liability. And, it's like, okay, what happened? And so there were a couple things that happened. There were some people that got caught in the perfect storm.
Yes.
Where everything happened.
Everything. Changed jobs. They lost dependents. They took out of a retirement. They did things that would have hit them regardless of the tax law changes. And then there was the tax law changes. So there were those people.
Right. It just compounded everything. And so, so one of the first things that happened, of course, is with the W-4s, right? Yes. Where, when we had the tax law implemented, the IRS adjusted that for you.
Right.
They didn't go so well.
Nope. And most tax professionals knew as soon as we saw the change, and the fact that they didn't let people make the change, but they made it for them. And some checks were like $50 more. Some were only 10 or 15. If people got a raise, they may not have noticed. But they kind of did it on the sneak. They said it, but they didn't really say what was going on.
Right.
Payroll departments kind of had more of an inkling because they were the ones waiting on the new W-4. But then they didn't require people actively to change it, which was the first issue, is that people were like, I didn't change anything.
Right, and you should have, and that's the thing, is that
you should have changed it.
Right, because because previously that's what you had to do. Everybody had to redo their W-4s, and this one there was not that emphasis really, where it's at the job. You heard about it in the news, but that's really only if you were looking. It wasn't like this major headline, like, public announcements. You know how to do those emergency broadcasts? Right. Go check your W-4. That's what they should have done.
You need to change your W-4. That didn't happen.
So with that, people wound up getting more money home
in their checks throughout the year.
And so that then, reduce the refund, right? And so what I would tell you to do is to look at your last year's taxes and look at your total tax due, and look at your current year and look at your total tax due, and really look at the amount, because you know what? You may have actually paid less in taxes, but because that you're so used to a certain amount of a refund, and you have more money coming home, that
it canceled out.
Yeah, it really did. It canceled out. So you would have you paid less, but you just got less back.
Which is the whole purpose of our tax system. It's not to get people large refunds. It's not to have people owe major balances. It's to break even. So the system is set up as a pay-as-you-go. You're supposed to pay what you owe, and at the end of the year, the reconciliation process should be that you break even. That doesn't happen in our society, and we get caught up on large refunds, quick refunds, refund checks. Oh, I didn't have to owe, or oh my God, I owed so much. When the point of the W-4, even though they partially failed at handling it correctly, but their intent was that people would get their money throughout the year and break even at tax time.
Right.
Which is the way our system is set up to be. But with the complexity of the tax law, the changes of people's situation, it never really works out that way. But honestly, this year was probably closer than any other year with people actually hitting dead on with maybe what they owed or should actually get back.
Right. Because I actually read a quick article from CNBC that just published about an hour ago, and they were saying that this year the IRS paid out about $5 billion less in refunds this year than the same time last year. So that means that people are getting more money home and there's less refunds that need to be issued. So now, along the lines with the W-4s, there's supposed to be a new one coming out.
Yeah, they're still touching it.
Yes, they're still putting their little hands on it. Just
yeah.
So, but
they're trying to perfect it. They got to get it right.
Right. But with that, though, if you know that there is a new W-4 coming out, be proactive and go and make your own adjustments so that you can try, like Ty said, is to break even as much as possible. So you're not getting a whole bunch back, or you're not, owing a whole bunch either. So, but one of the deductions that went away that I think it really had an unintended consequence was the unreimbursed employee expenses, where, our salesman type people, our service type people that are employees really took a big hit because they normally have to invest in their businesses out of their own pockets, in their jobs out of their own pockets, but now not being able to take those deductions.
In addition to the other itemized deductions, because it was only available to people who itemized in the first place.
Right.
And given that we increased the standard deduction, less people itemized anyway, so it kind of was it may have gone away. They might not have had enough of those deductions to take, but the few people that could itemize and take those deductions and couldn't, they owed more.
Yeah.
I had quite a few clients that were used to taking either parking or mileage or union dues or things like that totaled enough to push them over the itemization limit. And that being said, that some of the states, obviously, that didn't conform to this, if you didn't itemize on the federal, you also didn't on your state in some states. Some do allow it, like California, but Virginia, where we are, did not. So if you actually did not itemize on federal, you couldn't on state. So those deductions didn't help you in both places. So you actually got hit both times.
Right, exactly. So when you think about the people that, like I said, it was kind of like that perfect storm of things that, were hit by the reduced SALT limitations, and then, those unreimbursed expenses being gone. And so, and then of course people were like, well, what about charitable contributions?
They're there. They're there. You already can't take them because you're already limited on SALT. And let's talk about SALT, because to me, that was the main one that hit more of the middle class and higher income people that actually still itemized. They weren't part of the group that took the standard. They could still itemize, but they were limited in how much they could take in itemized deductions, especially their taxes. And in places like Virginia, where you have a personal property tax, you have real estate tax, you have income taxes from your check, all of those for a married filing joint or single return could not exceed $10,000. In this high cost of living area, that's easy to do.
Right. You can do that without
blinking, just from your job itself,
right.
Not even adding real estate or personal property. So most of the time, in previous years, I'd be like, hey, didn't you pay personal property tax on the car? And they'd be like, oh, yeah, let me send you that receipt. This year was like, don't worry about it.
Don't worry about all that.
Well, actually, that's not really true because they can still take it in Virginia, but it was almost like, don't go digging for all these extra things because you're already limited.
Because you're already limited.
But, that was a big deal, is the tax limitation, the unreimbursed business expenses, which all of these were Schedule A, it really affected the outcome, I think, of most tax returns this year.
Yeah, and I also saw another article talking about the exodus from the high property tax states to lower property tax states. But, the originating states are not, playing that. Like, you're going to have to really show that you do not live here anymore for you to not pay us these taxes.
They still want their taxes. But yeah, it is tough. And the higher states really did get hit harder than others. And I'm looking certain Facebook groups with other professionals, and people are saying, oh, my clients came out fine. This tax cut was the best thing ever. Mm-hmm. And it's like, others are like, oh, mine got screwed. They all had to, well, I think you have to look at where the people live.
Right.
To really determine how this affected people in general. Because the lower cost of living areas probably did benefit more. Mm-hmm. Places like Texas, where most of those people very rarely itemize because they don't pay a state tax anyway, and the property values are not that high, so their itemized deductions never were high enough. They got a higher standard. They didn't pay taxes anyway, so they weren't really affected by the SALT. If they could itemize, all they did was real estate taxes and things that they were able to do it even with the SALT limitation.
Right.
So you have those states, and then you have New York, who they pay taxes on, like, breathing air.
Yeah. Exactly.
That normally were deductible, and now they're not.
It's not. So yeah. So this season really was. It was tough all the way around because even with the form changes themselves, I kind of felt like I was on a scavenger hunt to find, like, where did this number come from? Like, so having to go and,
net things together and pull them there. It was like, geez, we need to bring abacuses back.
Right. Because it would totally make more sense then. Right. So yeah, that in itself, because the way it came out on the 1040, from your income to your adjusted gross income was just this number change, and people are like, okay, well, where did this come from?
And the funny part was we had to track it down.
And
go to Schedule 1, bring it back over, pull this schedule. I mean, it was really
the whole schedule thing. I'm sorry, I'm not loving
terrible.
it. Yeah, just not loving that at all. But it was a what happened all the way around, both for the taxpayers, also for the tax professionals in dealing with the new forms and being able to explain to their clients, like, okay, here's where these numbers are coming from.
New forms and software challenges. You have to realize when the IRS does something this massive, they have to share the changes to even software providers as well. And the government was shut down early. A lot of the publications hadn't been finalized until the tax season had already started.
Yes.
A lot of the states hadn't made decisions. Virginia won, and till the tax season was already underway. So our hands were tied,
right,
with being able to do certain things, waiting for software updates, waiting for state decisions, waiting for the IRS to release publications and rules for handling certain things. It was really stressful.
Because people wanted their taxes filed now, and we're saying, wait, or we're going to have to amend, or, so it was
and
just.
And then there was the extender thing that just popped up and disappeared because they never voted on the extenders with all these other changes, and the government shut down everything else. Extenders just got.
It's just like, no, we're not.
But then somebody revitalized it.
Yeah,
mid-season and was like, "Hey, we should bring these extenders back," and we're like, "No."
Exactly, just like returns. No.
We've already had enough issues, which they didn't bring them back.
Yeah. So so that's why it was so everybody went through a tough season, and so we still have extensions to file, and because of all of that stuff that was going on, people were just like, you know what, I'm going to wait, and didn't feel ready because of first of all, it was the fear of impact. Like, people were just not filing because they were afraid of what that outcome was going to be, even though that's really not a good reason to not file, because you're going to have to file anyway. But it was just that inherent fear because of all of the headlines and everything of what was going on. And so we're still, that's why, it was a later season for me.
Yeah, and it's still late. I mean, it's just still going.
It is still going. And so I have the highest number of extensions that I've ever had.
Everybody I talked to has had more extensions this year than ever. And then there's people who don't even file extensions. So you'll still be filing their returns later on. They just didn't file an extension. So it's ongoing. It's tough. If you haven't filed, you need to still file.
Yes, please still file.
And it might not be a bad thing that they waited, because we are kind of caught up on the software issues and the rules and things like that at this point, to where anything we do now should be more accurate than maybe it was in February before things were released. But
right, because we were having to go back and hand check everything to make sure
it was a manual tax season. It was like, does this make sense? Is this right? So hopefully we're a little traumatized.
Yes, traumatized. That is the word. Traumatized.
It was a traumatizing season for taxpayers and preparers alike, but we're here. We survived to tell the story.
But I think the upside to this, though, is that a lot more taxpayers are paying attention to what's going on in their tax lives.
That is good.
And I've seen a lot more tax planning appointments being made, because the work to reduce your tax liability is done during the year. So tax planning. Absolutely. Tax planning is crucial to you reducing your tax liability as much as possible. You just can't pop up in April and we can fix it. That's not it. So a lot more people are involved in tax planning and looking at how their taxes look in their overall lives. So that is the benefit
as a professional. We have now can get more involved with what our clients' expectations will be for the tax season, and we can make changes and discuss changes with them that can affect their situation next year. So estimated taxes may be an issue, increasing withholding might be a possibility. It may be that they invest in different things, or not sell a rental property, or possibly sell a rental property when income is going to go down or something like that. So those are things you need a tax professional for. There are things that software like TurboTax can't help you with. They can file your return, but they can't really help you plan what's going to happen the next year. You're kind of stuck with it by the time you file with them.
Right, exactly.
So you really should, discuss your situation with the professional, an EA, CPA.
Yeah. And the other thing I read, because listen, if y'all don't know, I read the tax news, okay? So the other thing that I read is that the IRS is going to be asking for dates of divorces now.
Oh, yeah. That is a newbie.
Yeah. In the,
because alimony, as of now, 2019, is no longer going to be deductible.
Right.
And we talked about this when we talked about Jeff Bezos.
Yeah, right.
We were saying
no
longer income is no longer deductible starting in 2019. But prior divorce decrees were grandfathered in. Right. But when you're filing the tax return, you don't know when they were divorced unless you enter the date. So I guess they're going to have it to where we actually ask the person, when did you get divorced?
Right, where you actually have to enter it now, because, normally you just have to enter in the Social Security number of the person that is receiving the alimony, and they had to claim it or whatever. But now they're asking for the date, because that's really going to be an audit point to make sure that the people
either could deduct it or shouldn't report it as income or whatever.
Right. So that date is going to be important.
Complex rule.
Oh, we have a question.
We do have a question. Latoya Jean is saying she wants to get some information about adding training for a few ladies to help them offer tax services as an additional source of income. What would y'all say about that?
She wants to train.
They want to learn how to prepare taxes. Is that what?
I think so, yes.
Okay.
They can contact us right here at the Income Tax School and ask for Maureen. She'll be happy to assist with getting information on how that training can be provided, using our materials and becoming licensees to teach other preparers. So just call us here and ask for Maureen. She'll take care of you.
Absolutely. So, yeah.
I think that's pretty much it.
Yeah, that's it. So we're here. We have survived. We should have T-shirts or trophies or something.
Right, we survived 2018. We'll be back next month, not the same time, not the same channel, but we'll come back in May.
Yeah, we'll be back.
We'll have something else to talk about.
Absolutely.
See you guys then.
Bye, guys.
All right, thank you so much for joining us, everyone. If you haven't already liked us on Facebook, please give us a follow, and we'll see you next month. Thank you.
Bye.